All right, let's talk about a question that is, absolutely make or break for anyone with startup equity. Your company gets acquired. What happens to all your stock? Let's get right into it.
So imagine this. You get the email. It's happening. The startup you've poured your blood, sweat, and tears into is being acquired. And yeah, first feeling is excitement. But right after that, this huge, kinda scary question pops into your head. What about all that stock I haven't vested yet?
And that's really the heart of the issue, isn't it? For the founders and the big investors, an acquisition is almost always a huge win. But for you, the employee, it's a moment of massive uncertainty. Your job, your team, your future, and, of course, your equity are all suddenly question marks.
But don't worry, there's a built-in safety mechanism designed for this exact scenario. Think of it as a kind of parachute for your equity. It's called acceleration.
So vesting acceleration is just a fancy term for a clause in your stock agreement that hits the fast forward button. When a certain event happens, like the company being sold, it can make your unvested shares become yours, like right away. It's a critical safety net. But how that net gets deployed, well, it all depends on the trigger.
Let's kick things off with the most direct and maybe the most simple approach, the single trigger.
Single trigger is pretty much exactly what it sounds like. Only one thing, a single event, needs to happen for your equity to accelerate. And that event, it's the acquisition itself. The moment the deal is signed, boom, some or all of your unvested equity is suddenly yours, an instant payout.
And right away, you can see the fundamental tension here. From the employee's side, this is amazing. It's an immediate reward for all your hard work that led to this exit. But flip the coin. If you're the company that just spent millions or even billions to buy the startup, this is a huge red flag. Why? Because your new key employees are fully vested on day one. What's stopping them from cashing out and just leaving? That massive retention risk is exactly why you don't see single trigger very often anymore.
And that exact problem, that risk, is what led the industry to a much more common and I'd say more balanced solution, the double trigger. So, as you probably guessed, a double trigger requires two separate conditions, two triggers, to be pulled before your unvested equity speeds up. It's really designed to strike a fairer bargain, protecting both you and the company that's buying you.
So, what are these two triggers? Well, the first one is the same as before. The company has to be acquired. That's your change of control. But that alone does nothing. The second trigger also has to happen, and that's usually an involuntary termination. Now, this means you're let go without cause, or, and this part is super important, you resign for what's called good reason. Good reason is defined in your contract, but it usually covers stuff like the new company slashing your salary, demoting you, or telling you have to move across the country. So both of these things have to happen, usually within a year of each other, for your acceleration to kick in.
And here you can really see the balance at work. For you, the employee, you lose out on that immediate cash in, which is a bummer. But what you gain is this really powerful safety net. If the new owners try to mess with your job, you're protected. And for the acquirer, this is the whole point. It's the perfect retention tool. It creates a powerful financial reason for all the key people to stick around and help with the transition, making sure the business they just bought doesn't just fall apart.
Okay, so we've got these two very different philosophies on the table. Let's put them head to head to really see the trade-off in action.
When you see it laid out like this, it's pretty crystal clear, right? Single trigger is about one event, the acquisition, and it's primarily designed to benefit the employee with an immediate payout. It's all about rewarding past work. Double trigger, on the other hand, is about two events, the acquisition plus a job loss. Its main benefit is for the acquirer because it helps them keep the team together. It's all about ensuring future stability.
So, given this big trade-off between an immediate reward and future stability, where has the tech industry actually landed? Well, it's not even close. There is a very, very clear winner.
Yeah, the verdict is in, and it's pretty much unanimous. For any venture-backed startup you're likely to work at, double trigger acceleration is the standard. It's what investors expect, it's what acquirers demand, and it's just seen as the fairest, most practical way to handle things for everybody involved. And hey, you do not have to take my word for it. Institutional Shareholder Services, or ISS, they're a huge voice in how public companies are run. They say it flat out. Double trigger is considered the best practice. When a group that influential calls it the gold standard for a change in control, or a CIC, you know it's the real deal. And the lawyers agree too.
Top law firms have analyzed these deals for years, and they call double trigger the most prevalent form of protection. And why? Precisely because it nails that delicate balance. It protects employees from getting a raw deal after an acquisition, while also making sure the new company actually gets the stable team and the value that it paid for.
So we've settled it. Double trigger is the standard. It makes sense for the acquirer. But it does leave us with one last kind of nagging question. How well does it really protect you, the employee? That whole safety net hinges on that second trigger, especially on that little phrase, good reason. So what really qualifies? Where is that line drawn? It's a great reminder that while the system is designed to be fair, in the end, it's the fine print in your own contract that truly decides your fate. Something to think about.